Okay, I'm going to go over an example here that's going to sort of highlight many of the points that John just went over in the presentation. And again, this is just sort of a thing to let it wash over you. What we want to do here is to show you a strong case of why estate planning is important. If anybody wants to check the figures and the numbers and everything, I can assure you I've gone through them and they do add up. The only thing we discovered is that the husband actually died in 2005. He died just a week before this session, so anyway, that's the only change. And we're going to be talking about the economic advantage of estate planning. We're going to use an example to show the benefit of using or the cost of not using estate planning. And the example follows a hypothetical family with forest land as its primary asset through the death of both parents to show the full cost of transferring family assets from one generation to another. And here's the hypothetical family. The family consists of a husband and a wife, 3 children and 3 grandchildren. The husband and wife are both 80 years old, retired, and living from their investments in forest management and stocks. The husband is assumed to die this year in 2005 and the wife in 2008. So you need to change that to 2005. Here are the family assets. At the time of the husband's death, the couple's joint estate consists of a home place and forest land owned jointly by the husband and wife, and life insurance policies and stocks owned by the husband. The home place consists of a home and 20 acres of land with a fair market value of $250,000. So this is probably a pretty modest home. But they also have forest holdings consisting of 1,600 acres of land with a fair market value of $1,920,000 or $1,200 per acre. But it's worth only $640,000, that is $400 per acre in its use as timberland. Plus, it has timber valued at $2,240,000. So this is a typical situation with a lot of landowners. They don't really think of themselves as being wealthy, but they do have some forest land and they have some timber on it, and lo and behold, they're millionaires. The assets owned by the husband consist of a $500,000 insurance policy on himself with a cash value of $200,000 and a paid-up $75,000 policy on his wife, plus stocks valued at $350,000. In addition, we assume that $20,000 in deductible expenses are incurred at each death, and the couple has a total of $60,000 of debts that ordinarily would carry from one estate to the other, and we're assuming that the wife does not remarry. And here's a big assumption: the family works together harmoniously. A primary family goal is to minimize the total amount of federal estate tax paid. The family also wishes to maintain financial security and protect the continuity of management on its forest land. So we go into scenario 1, which is known as the I love you will, and John went over this with you earlier. Each spouse has a will specifying that if they are the first to die, all of their assets go to the other spouse. And this is probably the most common arrangement for married couples. It ensures that the surviving spouse has full use and benefit from all assets in the joint estate. But it is a guaranteed worst-case scenario if the value of the joint estate exceeds the amount shielded from the federal estate tax by the effective exemption amount. So if you're millionaires, this is not a good thing here. In our example, all assets of the joint estate go directly to the wife at the husband's death, which maximizes the tax base at her death when the assets go to the children. So the federal estate tax due at the husband's death is 0, so you think, well, that's a good thing right there. With the I love you will, there's no estate tax at the husband's death. But the federal estate tax due at the wife's death is going to be $1,455,000, more than 1/4 of the fair market value of the original joint estate. So that's a pretty big bite out of it. So here is the value of the joint estate at the husband's death in 2005. And you've got all of these. You've got a total, the two of them together have a joint estate worth $5,335,000. The federal estate tax payable at the husband's death basically is zero because of the I love you will type of estate plan here. Everything gets passed. The only thing is $20,000 in expenses there. All right, here's what happens to the federal estate tax, though, at the wife's death in 2008. She's got this big gross estate that was reduced only by $20,000 when the husband died. So they pay off all of her expenses, the $20,000 plus the $60,000, $20,000 expenses plus $60,000 in debts. So she has an adjusted gross estate of $5,235,000, and you end up with a tax on that of $1,455,750. So let's look at scenario 2 here. The family makes use of 2 estate planning tools available to everyone. This is in scenario 2. The effective exemption amount for gifts and the effective exemption amount for estates. So the effective exemption amount for gifts. The husband uses the new effective exemption amount for gifts to transfer ownership of the 2 insurance policies to the children in 2002. And as well, directly reducing the value of the joint estate, gifting the life insurance policies, prevents the additional $300,000 of face value in the policy from entering the husband's estate at his death. So the husband is transferring the insurance policies to the children. Of course, he could have made use of the $11,000 annual exclusion for gifts, but the transfer would have taken 4 years or longer, even using the split gifts. And also, to facilitate transfer and protect the policies, the husband could have placed them in an irrevocable life insurance trust. All right, here's an important slide. The effective exemption amount for estates. Both spouses are uncomfortable with having less than $500,000 in assets to live on. They divide title to their assets and debts equally and have their wills constructed so that at the death of the first spouse, the surviving spouse receives at least $500,000 and the children receive the rest, up to the full amount shielded by the effective exemption amount. So in addition to giving the life insurance policies, they're now going to equally divide the assets and their debts, and then at the death of whatever the spouse it is, in this case it's going to be the husband, they're going to pass over to the children the amount that's shielded by the effective exemption amount. So the size of a family estate, it is possible to transfer entirely free of the federal estate tax by making full use of the effective exemption amount. It varies each year. So, and John went over these, so we're looking at 2004, it's going to be $3 million. But it goes up to $7 million by 2009. So in our example, the amount in the joint estate is reduced by gifting, and the amount that goes into the wife's estate is further reduced by the husband's bequest to the children. The federal estate tax due at the husband's death is still zero, but now our federal estate tax due at the wife's death is $522,000, which is roughly 1/3 of the amount using the I love you will. So they've gone from approximately $1.5 million to $500,000 by doing these changes here. So they've saved $1 million under scenario 2, roughly. And here's how they figure it here. There's the value of the joint estate, $4,760,000. The reason it's lower, they pass the cash value to the insurance policies to the children. And then when the husband died, had $50,000 in expenses. There's a marital deduction there, but then the tentative tax base is $1.5 million. This is what's going to go to the children. And you end up with an estate tax of zero, which is a good thing. But the wife's gross estate now is diminished because $1.5 million went to the children. And then there's expenses. And anyway, when you figure out the estate tax that's left, $522,000. So that's a pretty good jump. Saved $1 million by just doing those few little tweaks there. The family's going to make 2 additional estate planning tools available to the family enterprise. They're going to use a special use valuation and deferral and extension of the estate tax. And John's gone over these things previously. Special use valuation. By electing to use special use valuation on the forest land and timber, the value of each spouse's asset for each spouse's estate for federal estate tax purposes is reduced by $870,000 for 2005. The maximum amount by which this provision can reduce the value of an estate. That should be 2005. Okay. Special use valuation of both the land and the timber is necessary to meet the 50% test that John went over with you. Remember, though, special use valuation of the timber means no timber can be harvested for 10 years. And by using this provision, the family can postpone paying any federal estate tax for 4 years and then can pay it up in 10 annual installments. So this is the opposite of what we were talking about yesterday. When you owe money, you want to pay it back as slowly as possible if you're not paying interest on it. So in our example, the amount in the joint estate is reduced for federal estate tax purposes by the special use valuation, which is $870,000. And payment of the tax is stretched over 14 years. Note that the formula feature of the wills kicks in. In order to leave at least $500,000 to the wife, the husband's bequest to the children goes to less than the full effective exemption amount. We're going to show you this in a minute. So, the federal estate tax due at husband's death is still zero. But look at this. The federal estate tax due at the wife's death is $177,750, roughly 1/8 of the original amount using the I love you will. And what is that? Or 12.2% of what the scenario 1 was. So that's 78% reduction in estate tax. All right, special use valuation. So here's the assets again. The important thing here is this. This is the figure. You take $870,000 out of that. That reduces the estate by $870,000. So you end up with a value of the joint estate at the husband's death in 2005 at $3,890,000. And have also given the insurance to the kids. All right. So the husband's gross estate is half of that, or $1,945,000. It comes down here. You take the marital deduction of $500,000, the expenses. You end up with a tentative tax base of $1,395,000. And what's going to happen to this money right here? That's going to pass to the kids. And so he ends up with a tentative estate tax of $510,000, $510,650, but he's got a shield there that protects $555,000, so the effective estate tax payable is zero. And then when the wife dies in 2008, you end up with a tentative tax base. She's got a much smaller estate here because, again, they passed off a lot of money to the children at the husband's death. So she ends up with a tentative estate tax payable of $177,750. So I always like to say this is where you need to hire a lawyer, not a forester. And is it worth paying a lawyer, I don't know, thousands of dollars to save you, what, $1,200,000? I think it is. And there are still other tax reducing strategies that are available to the family, including the use of the full $1 million effective exemption amount for gifts, gifts to grandchildren, which we didn't get into here, and donation or sale of a conservation easement, which is very popular now with Under Forest Legacy. Okay, and we could have used a form of business as another strategy. For example, a family limited partnership or a limited liability company that would have allowed the parents to transfer ownership of the forest land to the children and or the grandchildren through excludable gifts discounted for minority interest and lack of marketability. So, but this simplified example shows the benefits of deliberate tax planning even after EGTRA. So I think that's it. But now, any questions now?